Well, joining me for more is Jimmy Jang from Macro. Jimmy, great to have you back on AusBiz. All right, so what did we see overnight on Wall Street?
Yeah, morning, Olivia. Yes, one of the kind of main thing that we're looking at right now in the Wall Street is being very volatile. And the investor sentiment right now is probably the most pessimistic it has been since 2022. There are multiple factors that's playing here, with obviously concerns ranging from the slowing performance of the big tech stocks to macroeconomic factors, like obviously with inflation and the tariff tension as well. The retail investors are feeling that pressure at the moment, and we're seeing that shifting towards more caution in the market. And this kind of created an environment where the fear is now dominating. But from another perspective, this could present a valuable investment opportunity for us as well. So what we're seeing, the big seven tech stocks like Apple, Microsoft, and Alphabet have faced some big headwinds, especially over the last immediate 2 to 3 weeks now. And while they have been the darlings of the market for the past few years, their performance has been disappointing, and we've seen some sort of negative returns on both a weekly and a year-to-date basis. But what was really interesting is that the smaller tech stocks and also the sectors like semiconductors have actually outperformed. So the S&P 500, excluding the big seven, is up almost 5% this year. And this kind of divergence kind of suggests that while the market is tough on the larger players in the US, there are still some opportunities in the small and emerging tech and also other sectors like semiconductors.
What do you make of Trump's plans to remove a $52 billion US semiconductor chips subsidy law, and how do you see this impacting the industry?
Look, it's a good question, Olivia. That's going to play a major role because at the moment, obviously, the Trump government is placing a big bet on the semiconductor as a whole. So with the big projects like Stargate, now headed by Oracle and OpenAI, and also it's being funded by the Japanese bank SoftBank as well. So I think that's going to bring some volatility in especially the semiconductor industry. But from our perspective, we're kind of looking at a long-term view. In the long-term view, the semiconductors are the chip and shovels in the gold rush in the AI. So I'm very comfortable still with the semiconductor at the moment.
And you have some AI investment concerns with Microsoft and Meta. Why is this?
There is a big concern, especially even though we're obviously very happy with where the industry is performing. But for example, there's reports on the Wall Street have highlighted that the companies like Microsoft and Meta are kind of scaling back their AI investments. Now, that kind of raises the questions about the sustainability of the current AI boom. And we obviously seen a pullback in the AI infrastructure stocks like the data centers and the semiconductor firms, which also took a bit of a hit. So if these giants are pulling back, and it's kind of worth asking whether the expectations for AI are being overly inflated. So it's a probably good time to make sure that your portfolio is very well diversified. Although we like the industry as a whole, it's very important for the investors to make sure that they have a very solid, allocations in each sectors, including AI and also semiconductors. But it's worthwhile noting, but long term, the government is pushing for it, so we're very confident where I am.
Ongoing tariff issues. Okay, so Trump has recently announced a 25%, the delays on the tariffs for automakers. So do you see him potentially negotiating on other things that may be suggested to him?
Absolutely. Look, it's a big card that the Trump has at this stage, but as these trade tensions growing further, and also the broader economic consequences start to retaliate against US, they definitely have to probably come to that stage, right? So one of the main things is that with these uncertainties with trade wars, the investors must perceive that slowdown in global trade. And one of the main things that the investors have been doing really well with us at the moment is making sure that we have a certain shorting or hedging positions on the portfolio. The volatility that it's offering to the market is grossly very high. So if you look at that fear and greed index, recently it hit the 18. Now that's a very clear signal of extreme fear in the market. But if you look at in the history, when this index drops below 25, it's often a sign that the market is oversold. So these are probably a good time to make sure that you have that kind of hedging in the shorting positions against the market to make sure that you don't suffer the significant loss when the market pulls back, as we have seen both in the US and Australia. But in the meantime, we can't control what's happening with diplomatic issues and the trade policy. So we can only kind of monitor and prepare for it. And the best way to prepare is to do it now before it's too late.
And on the economic data front, yesterday we had fourth quarter GDP in Australia that came in better than expected. What are your thoughts on that? And separately, what are your thoughts on China's growth target for GDP around 5%?
Yeah, look, the economy has shown some surprising results. So we saw that 0.6% growth in the fourth quarter, with the annual growth accelerating to 1.3%. Obviously, a lot more stronger than the many have expected. So that kind of indicates that while the household spending has been slow in the past, but there's definitely been a slight pickup, particularly in the essentials like the rent and health, as well as the growth in the discretionary spending in the retail and hospitality. So that's definitely suggesting that Australia may be navigating the global economic challenges a lot more better than the market has anticipated. So, but obviously that there's looming concern of the potential defense spending increase and also the global trade uncertainties that could impact the economy moving forward. So, in lieu with that, the geopolitical tensions, particularly with China, have that potential to disrupt the market stability, especially in the Asia Pacific region. So the US has always been advocating for Australia to increase defense spending to counter China's rise. So that could put a lot more pressure on these public finances. And additionally, if the US and China's trade issues continue, then Australia may feel the ripple effect in terms of tariff and obviously the global supply chain disruptions as well. So the China is definitely one of the taking more aggressive approach with their stimulus packages, as you mentioned, Olivia, and including those large sovereign bond issuance and also the fiscal spending, obviously aim to boost the economic growth. But we just need to monitor. There's nothing that we can pretty much expect right now. One thing I want to kind of suggest to the viewers is to make sure that we have a very good balance of the portfolio sectors, so not too much weight in the Australian miners, which will be probably the main sector that's going to suffer volatility from this news flow from China. So, but it could definitely provide a boost in the global growth if China actually succeed in stabilizing their economy.